Financial instrument that is categorized as debt instrument can be classified either as at amortized cost or at FETOCI or at FETPL. So for classification of amortized cost, the instrument should be held under business model that is having objective to hold the asset for collecting contractual cash flow, and the contractual term of the asset gives rise to cash flow solely payment of principal and interest. If these two conditions are satisfied, first is asset is held under the business model having objective for collecting cash flow, and the contractual term of the asset that gives rise to the cash flow is the solely payment of principal and interest. If these two conditions are satisfied, the debt instrument will be classified at amortized cost. And in this case, at the initial recognition, the debt instrument will be measured at fair value plus directly attributable transaction cost. And at a later date, it will be classified at amortized cost. The second category is FET-OCI. So debt financial instrument that is debt can be classified under FET-OCI, which is held under business objective that is achieved by both collecting and selling the financial asset. In the amortized cost category, it was only collecting. But in FET-OCI, it is collecting and selling of the financial assets. So objective is achieved by both collecting and selling, and the assets confirm the SPPI test. So in this case of FET OCI, we need to recognize initially and at each reporting date the financial asset at fair value. And any movement in fair value is to be recognized in OCI. Further, any interest income, impairment, forex gain loss on the debt instrument, that is financial asset, is to be recognized in OCI, and at the time of derecognition, whatever is we have accumulated in OCI because of the movement in fair value or interest income or impairment, etc., we need to reclassify cumulative gain loss previously recognized in OCI to profit and loss account. So at the day recognition, whatever we have recognized in OCI, we need to reclassify it to P&L. And next category is FVTPL. So the financial asset that is debt, which is not classified in amortized cost or FVT-OCI, has to be classified as a FVTPL. So we can say it is a residual category for classification of debt instrument. Apart from it, holder of the debt instrument, that is financial asset, can choose to elect FVTPL classification, but it is first irrevocable once it has opted for the FETPL classification. It cannot be revoked subsequently, and this classification is allowed to choose only if doing so eliminates or significantly reduces a measurement or recognition inconsistency that we can call as accounting mismatch. For example, when there is an amortized cost liability that is used to fund a FVT OCI financial asset, and both these use a common risk that gives rise to opposite change in fair value that tend to offset each other. In that case, both the financial liability and financial asset can be measured at FVTPL because they are eliminating the accounting mismatch in the classification. Further, debt instrument included within the FETPL category are measured at fair value with the all changes we need to recognize in profit and loss account.